Today on the Joseph Carlson Show, tariffs are back, and this time they're not just a negotiating tool, they are in effect. The Trump tariffs on Canada and Mexico took effect last night, with added duties on China. China retaliates against the US with tariffs. Both Canada and Mexico are currently talking about doing the same thing, implementing retaliatory tariffs and measures. The Trump tariffs showcase his extraordinary presidential powers and its limitations. With the tariff war officially started, the banks are already ahead of it. Goldman Sachs has rolled out a suite of downside protection ETFs as market volatility picks up. And as you can imagine, the market doesn't like this news. It creates uncertainty. Uncertainty with businesses, uncertainty with the economy, uncertainty with partnerships, and so on. And if there's one thing the market hates more than anything, it's the unknown. Most companies today are in the red, and some of them in the red by a lot. Tesla, for example, is getting crushed today, and it's on a strong downward trend. Other consumer companies like Visa, MasterCard, American Express, JP Morgan, the big banks, Berkshire, S&P Global, Moody's, Walmart, Costco, all of these companies are in the red today. There's a few standouts. Apple, for some reason, continues to stay strong. Investors truly don't want to sell their Apple shares, and Google's having a slight bounce back after a major sell down. Even Meta, after its incredible win streak, is having a massive sell-off. The S&P 500 is down only 3% over the past week. Year to date, it's only down 1.5%. But with the market being down only 1.5% year to date, it may give the impression that there's not really any good deals with this sell-off. In this market today, there are companies that have sold off far more than others, ones that have gone down dramatically just over the past month, creating opportunities for investors. And I'll be highlighting what I believe are some of the best buys in the market today. So we have all of that to get to, plus much more in this episode. Let's go ahead and jump in. Now, when we look back just over a week ago, we're looking back 12 days to February 19th, I published an episode, my most recent episode, that says that Bank of America warns about a mega bubble worse than the .com and Nifty 50. Now, this episode goes over a host of information, charts and data showing that things in the US are more expensive than they historically have been. Now, comparing it as a mega bubble or to the .com era or Nifty 50 is a whole other thing, but either way, this episode went over that prices have become expensive. Expectations are high for US companies, and that typically this is followed by future expected returns that are lower. Now, since this video, just on February 19th, if we look back over the past year, the S&P 500 has been climbing the entire time. And if we look back just over the past month, the S&P 500 continued to climb and climb until we get to February 19th. Since that day, the S&P 500 is currently down 6%. And it continues to fall. Anytime stocks are expensive and they need to come down in price, it takes a catalyst to kick them down. It takes a catalyst to get things started with the decline. And in this case, the catalysts are geopolitical economics. The first piece of uncertainty was the spat that happened with Zelensky, President Trump, and Vice President J.D. Vance in the Oval Office just a week ago. This was supposed to be a great event, ceremonial. The agreement had virtually already been made previous to this meeting. Zelensky was hosted by the White House to sign an agreement that would align the economic interests of the US with Ukraine with the ultimate goal of ending the war between Russia and Ukraine. What started as a cordial meeting ended with a shouting match with each party talking over each other, taking jabs at the other side, and it ended with no agreement signed. Now you can go online and get all the hot takes you would expect from the typical sources. Whose fault it was, who caused the debate, who insulted who first, who was out of line. Ultimately, that doesn't matter to the markets. What matters to the markets is having peace and having certainty. And we didn't have it here. Investors are already dealing with uncertainties with geopolitics, but now we have further uncertainties with another thing the market doesn't like, which is tariffs. Tariffs create uncertainty with business, with planning, and with CapEx investments. Investors see tariffs as another thing to concern themselves in an otherwise stable market. And President Trump implemented tariffs last night. US importers and their customers are about to experience the full force of President Donald Trump's unprecedented use of emergency economic powers. To that point, 25% tariffs on America's top two trading partners, Canada and Mexico, went into effect at midnight Tuesday, as did an additional 10% tariff on Chinese imports. Canadian energy will be tariffed at a lower rate of 10%, also as of midnight Tuesday. And of course, Canada, Mexico, and China are all implementing retaliatory tariffs.
The U.S. tariffs came into effect in the early hours of this morning, and so did the Canadian response. Canada will be implementing 25% tariffs against $155 billion worth of American goods. starting with tariffs on $30 billion worth of goods immediately, and tariffs on the remaining $125 billion of American products in 21 days' time.
Canada is reasonably putting on tariffs both immediately and in a staggered effect. The president of Mexico also said they would respond with retaliatory measures, but they didn't give immediate details. Those will likely be coming in today. China's already hitting back with a slate of retaliatory measures. They've coordinated actions across government bodies, including a series of new tariffs on American products as well as controls on US companies. So China's using a double-sided approach of not only doing retaliatory tariffs, but also leveraging their control over some US companies. Now you may be asking, what is the motivation behind tariffing countries like Canada and Mexico? What is President Trump trying to accomplish here?
And they can prove to the president they can stop the flow of fentanyl, then of course the president can remove these tariffs. But you've seen it. It has not been a statistically relevant reduction of deaths in America. It's just black and white.
The biggest reason they gave for these new tariffs is to stop the flow of fentanyl. Now, fentanyl may be a big problem coming across the border from Mexico, but it's much more difficult to argue that it's a large problem from Canada. Proportionately speaking, there's not many drugs flowing into the US through Canada, so there may be other motivating factors here. Mexico, China, and Canada are the three biggest trading partners with the US, and they import a massive amount of goods into the United States. In 2024, Mexico imported $505.9 billion worth of goods, China was $438.9 billion, and Canada was $412.7 billion. The three of these countries alone make up for well over $1 trillion of imported goods. Now, these are the ones that President Trump targeted. And I don't believe that fentanyl is the primary motivation here, for at least countries like Canada. Outside of imports, there's another topic regarding trade that Trump has talked about for years, and that is the trade deficit. A trade deficit means that the US imports more goods than it exports. Basically, the US is buying more stuff than we're selling. And that's because the US makes a lot of things outside of the US. When the US manufactures things outside of the US, that's fewer jobs for US citizens. Now, with President Trump running on an American First agenda, promising to bring jobs back to America and manufacturing back, tariffs can be used as an economic instrument to help encourage manufacturing in the US by making it more expensive to manufacture outside of the US. The motivation here would be to use tariffs to make everything else outside of the US more expensive, comparatively speaking to manufacturing things within the US. Now, with economics, it's highly debatable of how effective this will be at accomplishing that goal. Now, in terms of how long these tariffs last, that's up for debate. But there's a couple reasons that I believe this isn't going to be nearly as bad as people think. First of all, President Trump likes being popular. He likes being well-liked by the majority of people. And when we look at the tariff and breakdown from support of his constituents, we see that the majority of Americans can get behind tariffing China. They feel like there's a trade deficit, that it's been somewhat unfair, that too much stuff is manufactured in China, and using tariffs to some degree to encourage more manufacturing in the US, it's something that even the majority of Americans can get behind. When we do a breakdown of support of people either supporting or not supporting additional tariffs, over 50% of them said that they support additional tariffs on China. But then when you go through different countries and you get closer to the ones we're talking about here, in particular Canada, Mexico, or Europe, the support drops dramatically. We go from 50% now to around 30% of Americans. It's an unpopular position within the United States to tariff Canada and Mexico. So while Trump has the support and mandate of at least half of Americans to tariff China, he does not have anywhere close to the same support in tariffing Canada and Mexico or Europe. And that lack of support, that lack of popularity is something that will become meaningful in his future decisions. One thing I've mentioned continually with the topic of tariffs is that they are inherently temporary. Tariffs can be put on for a long period of time, they can last for a long period of time, but they are not done through Congress. They're not written into law. They're like a light switch. They can be flipped on and flipped off at any time. So this doesn't have a rigid process to ending or starting. It would be as easy as getting on the phone with Justin Trudeau, making a couple agreements, and then ending the tariffs. And we've seen this play out before. So there's no guarantees this is going to be a short-term thing, and there's no guarantees it's going to be a long-term thing. But with the lack of support from the general public to tariff Mexico, Canada, and Europe, I think it's unlikely for this to last a long time as long as it's having a negative impact. Another thing that makes me believe That overall, this is not going to be a long-lasting item that will hurt the market is another way that Trump operates. President Trump uses the market as a benchmark in reference to his success as a president. He will reference the Dow Jones and the price of it to determine whether or not he's doing an overall good job or bad job. From President Trump's perspective, a good president should have the market go up over time. He views US stock prices as a report card for his overall presidency. And it's difficult for me to imagine a president that views the market that way, implementing policies that hurt investors' returns long term. If the market went into free fall for an extended period of time as a result of these tariffs, I believe the policies would be altered. Now, whether or not these tariffs are long-term or short-term, whether or not they cause the market to sell off, for how many months they cause the market to sell off, there's one thing that I know as an investor that's been investing in this market 24/7 for the past 10 years. Just like investing, politics is typically never quite as bad or never quite as good as it seems. It's usually somewhere in the middle. There are more than one requirement for investors to be successful over the long term. Not only do they need to have good stock selection and be able to determine winning stocks from losing ones. That's something that investors can avoid if they buy the entire basket as an ETF. But if you're picking individual stocks, you need to first be a good stock selector. That's a big part of the equation. But the other part that applies to both ETF investors and individual stock selectors is behavior. Behavior determines a huge portion of your returns. Not only which stocks you buy, but when you buy them. Not only what sells you do, but when you sell them. And one thing that I've learned over the years is that when most people are freaking out about something, when most people are up in arms, when you're seeing the most extreme opinions about something, that's typically a decent time to start buying. In fact, when I look at my portfolio, my holdings, and my overall investment returns, I release this update every single month to my Patreon members that tracks my ongoing performance against the S&P 500 and the QQQ. Both the passive income portfolio and the story fund have outperformed either the S&P 500 and the QQQ from 2022 onward. That was the year of the big drop. So this isn't starting after the drop in 2022. This is starting January of 2022 before the market fall happened. The returns of the passive income portfolio as of March 1st is a CAGR of 11.19%. The story fund has a compounded growth rate of 18.44%, and the S&P 500 by comparison is 8.95. The QQQ is the lowest at 8.74. The QQQ struggled in particular because of the big sell-off in 2022. But when I look at my outperformance and I try to nail down what caused my portfolios to really do a bit better than the benchmarks, it comes down to these two things. Stock selection is a big one. I believe that selecting the correct stocks is a huge indicator of outperformance. If you buy weak companies, ones that face incredible levels of competition, ones that have dubious business models, ones that are held up on hype and they're not well founded, these are companies that aren't going to do well no matter how you handle the stock. Selecting the highest quality companies in the world with the best business models, high returns on tangible assets, companies that can grow organically, have operating leverage, have incredible brand value, is a huge part of having outperformance. But just selecting the right stocks is only part of the equation. The other part is handling your shares well. The biggest alpha generator in the story fund, and the reason that it's outperformed comparatively the benchmarks, is mostly because of Netflix. Buying in the top holding of Netflix created huge alpha. And it was not just because I identified correctly a very high quality company that would generate enormous amounts of cash flow in the future, but I also handled the shares well. Here's a screenshot of my activity feed from Netflix alone in 2022 and going into 2023. Now, this isn't filtered where I'm only looking at buys. This both includes buys and sells. But you're not going to see any sells because I didn't sell a single share. It was harder to justify this and sound like I knew what I was doing when I was actively buying into a company Bill Ackman sold out of. So it created some awkwardness with the content. A lot of people didn't think I was on the right track here. But buying into this company when other people were panicking about its future turned out to be the most alpha generating aspect in this portfolio. In the passive income portfolio, I can likewise attribute most of the alpha in the portfolio to not only selecting high quality companies, but buying into them well. If we go to another point in time, this goes from February 26th of 2020 to March 13th of 2020. And you might notice what I was doing during that time period. Through February, March, early March, I was buying more stock almost every single day. And if you recall, this was a point in time where it seemed like the world was ending. Literally everything was crashing down. The sky was falling. There was a virus killing millions of people. Stores were shut down. You had to wear masks to fly anywhere. There's huge debates over whether or not you had to get a vaccine or not. This was the worst of the worst of the worst. This was one of the worst times in the world's history, and it was likewise one of the best times to be buying stock. Your investment returns going forward will be almost directly proportional to your discipline in handling difficult times, knowing when to sell shares and when not to sell them. And when the world is crashing down, when everyone's selling out of the best companies in the world, it's typically not the best time to be selling. Those are the times to be buying. Now, I'm not saying that this sell-off is anywhere comparable to March of 2020. It's nowhere even close, and many companies today are still overvalued. But during the panic over the past month and the uncertainty that remains in the market, there are a number of companies that I believe have entered into the category of a buy, in some cases a strong buy. And I want to go through and highlight the ones that I have been buying and the ones that I will be buying. The first one is one that I've talked about virtually all year long, which is S&P Global. This one still remains a buy. It's still underappreciated by the market. I already own $115,000 of S&P Global in the passive income portfolio. That's $33,000 of gains. I own more of S&P Global in the Story Fund, $22,000 with $6,000 of that being gains. It's been a money printer in both portfolios, but I think it has much more room to grow. Over the past couple of days, I've written down my thoughts of what makes these different companies so strong. So I have them organized here. S&P Global operates as a leading provider of financial information, analytics, and benchmarks, serving global capital, commodity, and automotive markets. Its business model is built on a foundation of data-driven insights and has evolved over a decade to establish a strong, resilient presence in the financial service industry. The enduring attributes and moat of S&P Global are wide and deep. Over 75% of S&P Global's revenue is recurring in nature, providing services like licensing fees for indices, market data subscriptions, or company analytic tools. S&P Global is heavily embedded in financial frameworks. Bond issuance requirements, index fund tracking are heavily regulated. Governments and institutions rely on third-party standards to maintain market stability and transparency, a role that S&P Global has filled for decades. This dependence is unlikely to ever change, because creating new, universally accepted standards is costly and time-consuming, and regulators favor continuity. The common language S&P Global and Moody's have created for ratings has a similar network effect to English as a globally accepted business language. It's incredibly difficult to undo the embedded nature of this business. And I'll mention that all of these businesses that S&P Global operate in are also incredibly high margin, extremely profitable, requiring little capex investment and little stock-based compensation. This company is an organically growing, highly embedded, insanely profitable company. S&P Global's most enduring trait stems from the role as a benchmark provider, subscription-based revenue, reliance on data, trusted brand recognition, global diversification, and regulatory embedding. The stock trades at $520 today. It's down 1.8% on the day, and I don't believe that's warranted. I still think the company is a buy today. When we look at the free cash flow yield, S&P Global trades very similar, in fact, in line with the greater S&P 500. So it's trading as though it's an S&P 500 average company, while it grows cash flows much faster. They're expected to have $6 billion of free cash flow this year, and that is undiluted free cash flow. Pure $6 billion of free cash flow to return back to investors, to reduce share count, and to pay a growing dividend. And usually they come in above those estimates. If the market does fall, and that causes lowered interest rates, for example, S&P Global benefits when interest rates go down. So the way that I view S&P Global is very simple. If interest rates go higher, S&P Global will do fine. I still think it will be a highly profitable investment, better than most, and I think it will outperform the S&P 500 over the next 5 years. If interest rates go lower, S&P Global does extra well. It benefits even more dramatically than investors expect because of the new rise of debt issuance and market activity, which their entire business is a market business. In either scenario of higher interest rates or lower interest rates, I think S&P Global is a buy here, but it will be a particularly good buy if interest rates go lower. We could break down the revenue growth of the company, its organic growth even after the acquisition, revenue by segment, and how every different segment of the company is growing. All the margins of this company are incredibly high. We can look at the free cash flow generation. It's grown its free cash flow 56% year over year. When we adjust this for free cash flow per share, because they had to dilute a lot to do that acquisition, they printed a lot of shares. But that dilution is far behind them. It caused a temporary decline in free cash flow per share, which has now gone back all the way up to new all-time highs of around $18 in free cash flow per share over the trailing 12 months. This company is increasing free cash flow per share at 15% per year over the long term, and it should have the power to do that in the future. So S&P Global remains my top holding and one of my strongest buys here. But there's other opportunities and ones that I think are possibly even more exciting than S&P Global today. The next one that I would point out that I believe is a strong buy today is Amazon, and I'm literally buying it today. That's why you see the trade notification right there. I am adding $5,000 to my Amazon position, even though it's already an $85,000 position. I'd like to own more of this company. Just a month ago, Amazon was trading for around $240 per share. For example, we can look at the year to date and it's down almost 8%. When we zoom out just 1 month ago, it was trading $240. It's down 14% in the past 30 days. Amazon has recently surpassed Walmart in revenue. It's done so while growing Amazon Prime membership to over 200 million members. The membership has a high retention rate due to the immense value offered to customers. Amazon's logistics network is the most robust in the world, leading to faster shipping time than competitors. Amazon has built long-term relationships with high-income households over the past 20 years. Now they consider Amazon part of their life. The fulfillment network is CapEx heavy and difficult to replicate for competitors. The network is also becoming more optimized and efficient over time, with ample room for robotics and AI to improve efficiency and retail margins. Amazon's web service is the largest cloud hosting provider in the world, making up around 31% of global cloud infrastructure by most estimates. AWS has a highly diverse customer base with millions of small businesses and startups and medium and large enterprise customers, and the government. AWS offers a massive suite of tools and infrastructure with data center technical expertise that is difficult to replicate, creating high barriers to entry. Once a business builds upon AWS, there's also switching costs to moving off the platform. But Amazon has other businesses. Amazon Prime Video is an underrated asset by investors. It's arguably the second largest streaming service next to Netflix. It's now the majority of reason why new people join Amazon Prime membership, and Prime Video has a large selection of original content. It has also successfully built itself as a hub for entertainment and a platform to buy other entertainment through. You can sign up for stuff like Max through Prime Video, for example. This is an enviable position to be in, one that YouTube is currently trying to copy. Amazon's advertising business is layered upon and integrated into all its various businesses. It's in Amazon Retail with sponsored listings and product searches. It's in the Prime Video with advertisements on movies and shows. This is another high-margin service business with strong secular growth. On top of all of these core pillars of Amazon, which are massive and profitable and growing quickly, Amazon also has a series of long-shot bets. Pharmaceuticals, Zoox, Kuiper, AI Alexa, and so on. There's more optionality, opportunities, long-shot bets, and potential growth paths for Amazon than currently any other big tech company. Now, people talk about valuation of companies, and Amazon has two different stories to the valuation, one under the earnings and one under the cash flows. Similar to the companies that are doing the big CapEx investments, Amazon looks relatively cheap in terms of earnings, and it looks expensive in terms of cash flow. For example, right now, based on the next 12 months of earnings expectations, Amazon trades at a 32 multiple. It's cheaper than Costco, it's cheaper than Walmart, it's cheaper than a lot of companies out there. Amazon is not an expensive company based on the PE ratio, especially when you factor in earnings growth. For example, looking out just 1 year further to 2026, Amazon trades at a 26.7 PE ratio based on analyst estimates. So if Amazon just grows in line of expectations for the next 2 years, you own it for a 27 forward PE ratio, which is the cheapest it's ever been historically. On an enterprise to EBITDA valuation, it's also the cheapest it's ever been historically. But when we get to the cash flow, it looks more expensive. Amazon has a low starting free cash flow yield, and most of that is eaten up by stock-based comp. But this is a result of huge capital expenditure investments, which Amazon has done before. The zig and zag of free cash flow is directly proportionate to how much Amazon likes to invest in CapEx. In each case, investors are nervous about their investments. They think that they're not going to get a good return, even though Amazon has had an incredibly high ROI for every CapEx investment they've done throughout their history. For example, Amazon's free cash flow plummeted when they did huge CapEx investments into doubling the size of their fulfillment network. They did that aggressively, only in a couple of years, and the free cash flow went negative. But then the free cash flow stepped up to around $50 billion the following year. Now it's trending back downwards, which is different than what investors were expecting going into 2024. Investors thought it would continue to trend back upwards. But it's going downwards because we have new demand in artificial intelligence and AWS. Every single leader, both Satya Nadella, Sundar Pichai, and Andy Jassy, have said that there's simply too much demand. They need to create more capacity for all of this demand. So free cash flow is once again going down to make these investments, and I expect the very same thing to happen. Ultimately, the investments will be made, they'll have the initial brunt of the CapEx, and eventually the profits will come through when the CapEx gets lowered relative to revenue. I think Amazon is a company that can get to the point where it's generating $70+ billion in free cash flow continually. And it does so with little narrative of being disrupted. There's no imminent threat to Amazon. There's no company that really threatens its market position, its competitive moat, its diverse businesses. Amazon competes with everyone, but so far they've been beating everyone. The EBITDA and earnings show a different picture of earnings going up as they expense these items and amortize them. So you can see the earnings per share is growing rapidly. And this is what we would expect from this company reaching operating scale. Now, Amazon's a company that I also believe has a great AI story. I've said this repeatedly. It's not the companies that are making AI that's the most important. It's the companies that have the distribution and the mechanisms, the platforms to implement AI in the most meaningful ways. And I believe that Amazon has ample platform and room to monetize and implement AI to make their products better, to make them cheaper, to make them more efficient. So I also view Amazon as not only a company creating AI with their own models, but a huge beneficiary of implementing artificial intelligence. Right now it trades back to $200 per share. I thought it was undervalued at $240. I believe the correct share price for Amazon today is around $260. That's where I'd have it as around fair value. So right now, I view it as a buy. Next up is a company that's new to the passive income portfolio. We have Google. This is a strong buy for me today. It's a company that I've actively been buying at this exact share price. Google is now a $42,700 position with $96 in the green. Do you see that? We're flat on Google, and I feel great about that because I believe every share I own, every dollar of this is intrinsically undervalued, and it's only a matter of time until this increases. Now, I'm not 100% new to Google. I have owned this one for a bit longer in the Story Fund, so I have a $43,000 position, and I'm only $15,000 in the green on this one, which has done a little bit worse just because of the past month. Like Amazon, Google has had a rough 30 days. If we look at the 30-day performance, it's down 10.8%. Now, it's having, ironically, a bit of a bounce back today. So investors are concerned about the market, but they're buying up Google shares right now. It's up 2.25%, but this is now at $172, back to the range that Google was a few months ago when everybody was bearish on this company. Google's a company that almost never gets the credit it deserves. It really doesn't. It's a company that there's always something to be concerned about, always something to be worried about, and Google rarely gets full credit for what it's accomplishing, its cash flows, its balance sheet, its diversification. All of that seems to be pushed to the side because there's always a new concern for Google. And in some cases, those concerns are very real and very present. The concern of Google with large language models, companies like ChatGPT with OpenAI, Grok with Elon Musk's xAI, Llama with Meta, and so on. Now, I recently did an entire video covering the topic of Google in terms of how it plays into other LLMs, the market share, what I believe going forward. That's on my Joseph Carlson After Hours channel. So you can watch that one if you want to see a 40-minute breakdown of my in-depth thoughts on Google and the LLMs. But I can give you a brief summary of what I think of Google's business currently. Under the umbrella of Alphabet is home to multiple world-class businesses. Google Search Properties, that's the big one. The AdSense Network, YouTube, Google Cloud, Gmail, documents and enterprise services, Maps, Android, Chrome, Waymo, and more. It's one of those companies that has so many massive properties, and you might just forget a couple of them, like Google Maps, which is massive. But they own all of this stuff, and all of this stuff is very important because it's the lifeblood of the internet. Google has become the fabric of the internet, and it's highly integrated into multiple aspects of people's daily lives. Google's search volume, which is the biggest piece of scrutiny for Google today. It's the reason that investors are souring on this stock. They're concerned about the search volume growth in the face of pressure from LLMs. In a recent blog post from Google, they updated investors that search has now surpassed over 5 trillion search volume annually, and volume has grown since the release of the integrated Gemini responses. This means, despite the pressure from new cutting-edge LLMs like ChatGPT, Google search continues to grow organically with volume growth. So not just throwing in more ads and growing by more revenue, they're growing in total search volume. Organizing the world's information is a very big task. The appetite for information will expand overall with LLMs. Google is well positioned to grow alongside other forms of extracting and understanding information. Again, there is a blog post where Google kind of offhand just gave their search volume. Like, they didn't make a big announcement. They just acted like it was no big deal. They just kind of threw it in there, which I believe was a key piece of information for investors. It's something that's incredibly important to the story of Google. The question of whether or not search volume is growing. Here's the blog post. This came out yesterday, March 3rd. Now, they go through different developments they're doing, turning AI into action, summarizing stuff, all the usual stuff we've seen about artificial intelligence. Then you get to one section here. Right here, they say connect with consumers on search. And in the second sentence of this paragraph, they say we already see more than 5 trillion searches on Google annually. And with AI, we're continuing to expand the type of questions that people can ask. This means more opportunities for you to connect with consumers through entirely new kinds of questions. For example, with the launch of AI overviews, the volume of commercial queries has increased. Over this time period, we haven't had an update on how many searches were being done, and now we have a new benchmark. We have a new update, 5 trillion searches. They also say that this is not taking away from the searches, it's expanding the type of questions that people can ask. And it's increasing even after they've integrated Gemini into the query responses. Overall, search continues to grow. When we look at all the different times that they've mentioned their search volume, the previous time to yesterday, with that being 5 trillion, was way back in 2016, and that was 2 trillion. So from 2016 to 2025, search volume's grown from 2 trillion to 5 trillion, and it continues to grow in terms of their most recent update as of yesterday. Before that, we go all the way back to 1998. It started off small with 3.65 million, and 1 year later it went to 1 billion. In 2000 it went to 14 billion, 2001 it went to 55 billion, 2004 it went to 73 billion, 2009 365 billion, and then 2012 it went to 1.2 trillion, then to 2 trillion, then to 5 trillion. This is the company that investors are selling out of because ChatGPT. They're selling out of it because there's a new way to consume information. Now, like I've argued before, there has been dozens of ways to consume information and many big competitors to Google for over a decade. Amazon has a huge search box where you search products and buy stuff. That is a competitor to Google. But yet, throughout all of Amazon's growth, Google has continued to grow, and it looks like it will be more of the same from ChatGPT and LLMs. Now, of course, this could change over time. The future is uncertain. Maybe people really do gravitate over to all these competitors and they leave Google search. But this is one company where everything so far we know about this stock, every piece of data shows positive outcomes, even up to just yesterday. It's a company that's only being discounted by future unproven concerns. Outside of just the search volume question, which Google has in every way possible shown that they continue to grow, Google Cloud continues its fast growth and margin expansion. It's become a highly profitable segment of business. It has ample runway for growth. The large and expensive CapEx investments into cloud infrastructure should provide a predictably high ROI. YouTube remains the gold standard for do-it-yourself video platforms. YouTube Premium subscription has surpassed 100 million users. It now has more total time on TV than Netflix. Now, this fact is especially impressive when you consider that this does not include phone, tablet, and desktop, where a huge portion of YouTube watch time comes from. Just on TVs alone, they're bigger than Netflix. That shows you the size and scale of just YouTube. Google's Waymo has shown real promise. It's a very small business currently by revenue, but it's actively completing now 200,000 paid rides per week without drivers. They are actively expanding to more cities. Waymo's value to shareholders should increase as the proven model scales across the globe. Google is well positioned to adapt to changing dynamics in search, video, and cloud services. On every earnings report, they've beat investors' expectations, they've given strong guidance, they've given commentary that they are overall not concerned about new ways to find information, but they're very good at competing with these companies, and they've proven to do it for the past 10 years. But they are well positioned to advance in the future. I think the company's a strong buy today. Now, the next stock I consider a buy today is one that I've talked about a number of times. It's in the consumer category, and it's a bit of the opposite type of company that people buy going into what they perceive to be consumer-led recessions. It's Booking Holdings, which is a travel company. When I look at the company, it trades below $5,000 per share today, and just a bit ago, Booking Holdings raced up to around $5,300. So it went through a nice surge in price. The stock price went up quickly, and now it's pulling back, especially because we're getting new data and new concerns of a recession. So I want to put this in perspective of what I think about these type of companies, like Booking Holdings and consumer companies that are impacted dramatically by consumer-led recessions. First of all, recessions happen and corrections happen frequently. They're not abnormal, they're not unusual, they're something that investors should bake into the expectations along the lifetime of a company. We've gone through them many times before, and we likely will at some point in the future. We never know when one's going to really happen. Even analysts and economists can't accurately predict when a recession will happen with any level of credibility or accuracy. That's been proven over and over again. But we know that these type of things will happen at some point in the future. So what does that mean for Booking Holdings and other stocks? First of all, when you get into recession, it's not just Booking Holdings that will go down. Almost everything that we own and everything that we buy, everything that we trade will go down. And investors panic and scurry to try to protect their gains during a downturn. They flood for the exits. They want to be the first one out the door. They try to buy insurance. They try to buy premiums to protect from investing losses. You'll see constant narratives and talk about rotations into different sectors, ETFs that lower volatility, and so on and so forth. That's not how we should be dealing with potential recessions or market volatility. The better strategy is to have companies that can weather through and become stronger during a recession. I believe every one of my holdings can do that, and Booking Holdings is one of those. Now, I'll talk about how I view this company in a recession here in just a second, but I want to take a look at the overview and market structure of Booking Holdings today. It holds a dominant market position in travel, especially in the highly lucrative market of Europe. The European travel market is much more valuable than the United States travel market, and that is because of the structure. The European market for hotels is unlike the US, and it's highly fragmented amongst thousands of small businesses. So the average hotel in Europe might have like 20 to 40 rooms. And that's all they own. This creates substantial demand for an aggregator, someone to supply booking for unfilled rooms. This dynamic does not exist in US markets. In fact, the United States has a travel hotel market that's occupied by a few big chains, primarily Hilton and Marriott. These dominant hotel chains have more integrated marketing, rewards programs, and booking resources, and are less dependent on the external services like Booking and Expedia. That's why you can bring up Expedia on Qualtrim and Booking Holdings on Qualtrim, and Booking Holdings is multiples the size of Expedia, because Expedia is mostly popular within the United States, which is not that valuable. Booking Holdings is mostly popular within Europe, which is highly valuable. In the hotel business, every night with an unfilled room is viewed as lost revenue. There are high fixed expenses and low marginal cost to adding another room night of an unfilled room. This creates a positive dynamic for Booking Holdings, where unfilled hotels will be willing to negotiate for lower margins on additional demand to fill vacancies. They have the faculty, they have the cleaning staff to turn these rooms over every day. It doesn't cost them really any extra money, So they'd rather get those rooms filled even if they could make $30 instead of $50, because that $30 is still extra profit for the company. Now that's what Booking Holdings does. They say that you normally charge $50. Well, you can charge this person $50 and we'll take $20 of it to give you this booking. And that's the negotiations that take place. Hotels are willing to accept slightly lower margins to fill vacant rooms that they would otherwise make no money. Booking Holdings uses its marketing, its strategy, its platform, its technology to create that demand to provide to these small hotels where they don't have the unified marketing, they don't have the unified rewards program as a large national hotel. So Booking Holdings works as a tool, a mechanism to give all these fragmented hotel chains the same type of marketing prowess that large hotel chains like Hilton and Marriott have. They are a benefit to the overall ecosystem in creating demand for small hotels. So that is the value proposition that this company provides and the reason it's so successful. Now, Booking Holdings, when we look at the fundamentals of the company, it has a dominant market position, it's an asset-light business model, it has global reach and diversification, it has extremely high margins and profitability, making for a uniquely good investment. There's not many in the world like this. The biggest concerns for investors when buying travel companies is volatility and demand. If the US or the world goes into a recession, Booking Holdings will be one of the first companies to have earnings impacted as fewer people will travel. But even given this fact, the high margin and flexible nature of the business will keep them profitable in a downturn. Booking Holdings has such high margins that even lower revenue will still equate to a profitable company. And typically when a recession happens, it consolidates further demand for the scaled winner coming out of the recession. For the long-term investor, strong secular trends should matter more than short-term volatility. Booking Holdings is still well-positioned to be a highly profitable long-term investment. So today we have notes from Qualtrim explaining why companies like this have been trading down over the past couple of months. Shares of travel-related companies are trading lower amid market weakness and investors' concerns about tariff risk, which may reduce spending towards tourism. So while that impacts the business short term, and it may have a real fundamental impact if we go into recession or fewer people travel, the important thing here is the long-term secular trends. Booking Holdings is highly profitable. They can weather through any type of downturn the world has thrown at it. They've been through this time and time again. They grow their free cash flow per share above 15% per year. They're an incredibly asset-light business. They only have their marketing spend, which aggregates demand. And they're using new innovative ways to advertise for the company. So I view this as another buying opportunity, and I'll certainly be buying it if it trades lower. So there's a few companies that I've been buying and ones that I think are a buy today, and they're not the only ones. There's companies that have been unfairly sold off over the past couple of months, and those are opportunities for investors that remain disciplined in their approach. Now that's it for this episode. Hope you enjoyed. See you in the next one.